Dick, I got a question for you, Dick. Do you want me to give you the controls, or do you want me to put the book up myself?
Oh, put it up yourself, why don't you? And then we won't have any mess ups.
I can do that.
If you don't mind. I've got a couple comments on this Dave Ramsey deal, by the way, if you want to hear them.
No, we'd love to hear it.
Well, a couple things came to mind. Term is a liability. So you buy cheap term insurance. All term insurance is cheap. At least the guy understands that. But let's say you buy term and you're investing the rest in the stock market, and you're doing your damnedest to get 25 basis points more. It's a limited gain. In other words, the insurance is a liability, and the best you can do with it is realize a limited gain. Folks, in my book, in Chapter 4, that deals with term insurance, it isn't in there, but here's the thing about term being a liability. When you change a liability into an asset, changing a liability into an asset gives you an infinite gain. In other words, don't get some cheap term insurance that only benefits the company. Dave doesn't even understand there are different types of term insurance. There are a few companies where everything is stacked up to benefit the customer, and guess what? They're so cheap. This stuff's all within pennies a thousand of itself between all of the companies. It doesn't much matter. You really can't buy expensive term insurance. It doesn't exist pretty much. Maybe at Northwestern Mutual, that's about it. When you change a liability into an asset, you get an infinite gain. This is simply taking the IUL concept into a two-step process. Buy quality term insurance where the customer owns all the benefits, and then convert it later into an IUL. Guarantee yourself today that you're going to have the ability to grow into the IUL as your budget and your family situation and everything improves. So anyway, that's just my comment on that. Term doesn't have to be a liability. It can very much be an asset. And you're absolutely correct, Petro. On the market not returning 8%. So let's say your next door neighbor is Warren Buffett, and you guys you've just mowed the lawns and you're shooting the breeze, you and Warren over the fence Saturday afternoon having a beer after the work's done, and Warren says, Petro, I've got a hot stock tip for you. Are you going to listen to him, Ron? You know, hey, I hope so. The guy's worth about, what, 50 or $60 billion or 40 or, you know, who's counting at that point? I guess like Dirksen said, when you get above $1 billion, it suddenly becomes real money. So yeah, of course you're going to listen to him. And go back to April 8, 2013. We've talked about this one or two times before. April 8, 2013, CNBC interview with John Bogle. Not as recognizable a person, a name as Warren Buffett to most people, but this guy is the founder, senior chairman of the Vanguard Group of mutual funds. He's made trillions of dollars for mutual fund customers on Wall Street. Trillions. When he talks, do you want to listen? Absolutely, I do. If you don't, I think you're taking that vacation in a bag that Dave Ramsey's been indulging in. But anyway, what John Bogle says is stocks are highly likely to do better than bonds. John Bogle is making a prediction on CNBC. He's predicting what he believes the stock market will do in the next decade. It ain't going to make 8 or 10%, by the way. It's going to have two losses of between 25 and 50%. This is an unprecedented prognostication, folks, from a financial guru, one of the 2 or 3 top financial people, certainly in the United States, possibly in the world. The market is going to have 2 declines of 25 to 50% in the next 10 years. Stick to indexing. Remain an indexer is his recommendation. So first of all, I guess you can put this in perspective. Would you like to listen to someone like Jack Bogle, who's literally made trillions of dollars in the market for his customers, or do you want to listen to some yo-yo like Dave Ramsey that actually doesn't even understand how term insurance works? It's pretty much ridiculous. And then the other thing I wanted to toss in was there's another one of these. She's not a talking head, she's a writing head. Her name is Liz Weston. She writes a lot of crap for MS Money. And her latest deal about 10 days ago, it just floored me. It's called It's Not Too Late to Salvage Your Retirement. It's not too late to salvage your retirement. All right, how are you going to do that? And here's what old Liz Weston says. You've got 3 ways to do this. Number 1, spending a lot less. So dramatically reduce your standard of living. Saving a lot more, hey, reduce your standard of living, and working longer. Gee whiz, that's a great prescription, isn't it, for what ails people in their retirement plans. Just cut back on your spending and plan on working probably at least part-time for the rest of your life. And that's pretty much the common wisdom out there, conventional wisdom that's going on in the internet. Folks, look this stuff up. Print a couple of these. Here's one from U.S. News and World Report. Now, this goes back to February of this year. Why more Americans are working past age 65. Retirement at 65 is no longer a feasible option. Here's another one from the guy called the Life Coach. A real good coaching job. It's called The Best Retirement Plan. Work longer. Hey, this is baloney. It's just, you know, Oscar Mayer should be writing this stuff. It's ridiculous. Anyway, let's get to this book here. Petro, can we go to the introduction? I got a hard copy here. Let me see even where the heck that thing is. It is, there's just a couple little things in the introduction I wanted to cover on page 11. No, go to page 11, not from me. I'm rewriting this front, by the way, and I'm putting Jack Bogle front and center. So if you're like most people, you've gradually acquired these preconceived notions. Who from? Coworkers, relatives, friends, insurance advertising, financial pundits on television, hello Dave Ramsey, and even some insurance agents. Unfortunately, they're all wrong. You're dealing with opinions. You're getting opinions. Deal with facts, not opinions. As a result of all these opinions kicking around, of course we're figuring out none of them are right, people are getting this totally biased view of insurance and they don't understand it. They own it for the wrong reasons. They buy the wrong stuff, like Dave's saying, buy a cheap term policy. He's not saying buy a quality term. There's nothing wrong with a quality term. There is, however, with cheap term that isn't that the customer doesn't have all the benefits. And they pay far too much for the wrong thing, bought for the wrong reasons, and you can throw in this bag all this infinite banking, bank on yourself business about whole life. That's not quite as bad as Dave Ramsey, but it's, you know, it's a stretch also. So without an accurate understanding, you can't be a good consumer with your life insurance. You can't use your normal buying process. And I've thrown this stuff in the book, folks, just so you have kind of an icebreaker, some different things you can talk about with people when you first get together. And what is your normal buying process? As an agent, I'm here to help you use your normal buying process. I don't sell insurance. No way. I help people buy it. I help people use this normal buying process, which is firstly, know what it is you want and need and understand why. That's why this book was written, to help people understand why they need what they really need but aren't aware of it currently. And then compare your financing choices. And all life insurance is the same identical thing. It's a legal contract that says you die, we pay. from a company perspective, and that's it. There are simply different ways to pay for it. Term has an increasing payment plan. Whole life has a fixed level payment plan, and universal has a flexible payment plan. So today, let's jump down. There's a fundamental change in America's financial laws we're going to talk about in a minute. It enables you to use, very key word, you don't buy life insurance for what it is, you buy life insurance for what it does. You use it. It's a tool. A vehicle is another term I've heard used, to benefit the buyer while they're alive, not just the beneficiary. So you can benefit yourself today, and what you will get out of that, you're going to get higher fixed rates than you'd ever get from a bank. You're going to get stock market gains with no loss of principal or prior earnings. This is what Dave doesn't understand. He's assuming the market's going to do 8% from now till the cows come home. We are in a whole new world, folks. We are in the world that Jack Bogle is in. His feet are firmly on the ground. His head isn't up in the clouds somewhere, eating that piece of Bill's pie. Tax-free money, college, weddings, anything, future events. Doesn't matter what it's for. Be your own banker, okay? That's all that says. You get tax-free loans with no required repayments. You have to ask yourself, how is the money, on what basis are you borrowing the money? What interest rate are you required to repay it, that kind of thing. IUL, absolute, the loans are tax-free. There's absolutely no required repayment. It will eliminate taxes on your assets, income taxes when you withdraw as income. It'll also eliminate any potential federal and state premature, pre-59.5 penalties, post-70.5, that kind of stuff. Increase your spendable retirement income by even more than 300%. It depends on your age and your health condition. Has a comparable contribution to an IRA, 401k, or TSA. That's what this book is all about. It's designed to help people make their own informed decisions, so you as an agent are in the education business, not in the selling business. You help people buy, not sell, so they can wisely spend their own money. Because I don't believe any of you have the right to spend somebody else's money. I never did as an agent when I was out there, and I told people that. If you don't learn anything in the first 10 minutes, kick me out. Show me where the door is. I'm happy to leave. Not one person has ever done that, though, and I told them, I'm not going home and kick the dog or anything. My job is to help you understand how your money works, where it goes, what the benefits are of different avenues of funding retirement income, dealing with facts. So spending your own money is something only you're entitled to do. This is good that people understand that when you first meet them. It's going to differentiate you dramatically from the average salesperson. And people are intelligent, they're intuitive, they aren't stupid, most of them, a few are, sometimes, including me. We all are, but by and large, none of us are. We're intelligent people, and your prospects and customers are the same. Let them make their own good judgment. They need facts rather than all these Dave Ramsey, Susie Orman, ridiculous opinions that are out there. So financial reform means opportunity for everyone today. So what does that mean? We'll kick her down, Petro, to the next page. And there's a new financial landscape. The financial sector consists of banks, insurance companies, and stock brokerage firms. Those three kind of like sub-industries, you'd say. Their role has dramatically changed from what our grandparents, our mom and dad, and even us grew up with right up through the year 2000, through the end of the 20th century. And this whole landscape that people are familiar with, people like Dave Ramsey, they think it still exists. It doesn't. You take his next vacation at Disney World. It's ridiculous. 1930, when the stock market crashed, in 1932, the Glass-Steagall Act was put together, and this is probably on most insurance exams. You folks have bumped into this. It totally separated, absolutely firewalled banks, stock brokerage firms, and insurance companies. The reason is under Coolidge and Hoover, the economy, the financial service was deregulated, and we wound up getting into the 1929 stock market crash because of deregulation. Exactly the same thing, by the way, that happened in 2008. Goes back to the late 1990s when Newt Gingrich was head of the House and chairman of the House. Anyway, that's the same thing happened identically twice in a row. So that's, I guess, a classic definition of insanity. Anyway, because of this, each of these three institutions, it was forbidden by law that they would compete with each other. So they all had to have different products. So each institution, they offered different, and they still do today, different degrees of safety, liquidity, risk, potential reward. I'm down at the bottom here, Petro, and we're going to talk about banks. They're in the savings and transaction business. You give them your money, and they lend it to somebody else at a higher rate than they're paying you. And you're willing to accept this lower interest rate because your money is guaranteed safe. If you like this approach, you're a saver. Your principal is never at risk. On the other hand, the opposite of that is a stock brokerage firm. They're in the risk business. People are investors that use these, and these investors are looking for high upside gains. They're willing to risk their money in the stock market. They're at the opposite end of this risk spectrum from banks. And somewhere right in the middle are insurance companies. They've historically been in the protection and the distribution business. They assume, the insurance company now, we're talking about the industries. The insurance industry assumes all the risk, and they give guarantees in exchange for sharing the gains with them. I call the people that like insurance accumulators. They want to build and distribute capital. They want to receive favorable tax benefits, but they want safety. And at the same time, they still want an opportunity with some strong growth potential. They kind of want to have their cake and eat it too. Can you do that? Absolutely, because in 1999, the Glass-Steagall Act went away. Phil Graham from Texas was pushing this deal. The Graham-Leach-Bliley Act, these firewalls came down. That deregulated the financial services industry that had been highly regulated since the early 30s. Now, with these legal barriers gone, these financial institutions all of a sudden are performing the same functions. All three do the same thing today. You can go to an insurance company for what you used to get from a bank and vice versa. There's no shortage of places to put your money. You can put it in the bank. There's CDs. You can throw it in the market. You can buy real estate. It's easy to get confused with all those choices. So regardless of where you put it, it's going to be a similar result. An institution, whether it be a bank, a stock brokerage company, or an insurance company, they're going to pay you to use your money. And then at some point, you're going to get it back. How much you ultimately gain in the end depends on the importance you place on eliminating losses from your principal and prior earnings. Does your money grow tax deferred, or do you pay tax every April 15? This is a lot more important, folks, than the actual interest rate. That would be a CD or a bank account, of course. Are taxes payable when your capital is distributed? Or are you going to get the money back tax-free? This determines how much money you're going to have to spend, not pay taxes on. There are a lot of simple little concepts woven through all of this that I hope are helpful to all of you, such as it's not how much money you have to pay taxes on that's important, it's how much you have to spend. These are simple little factual truisms that people aren't used to hearing. The edge today is with an insurance company, because you can now get from a life insurance company what you used to get from your bank and stockbroker. Keep going, Petro. I think we may get through chapter 1 and 2 today if we're lucky. These benefits from your insurance company include safety of principal and prior earnings, low fees, lower than with Wall Street, and favorable tax treatment, both during accumulation and distribution. Properly using these benefits, it'll dramatically increase your likelihood of successfully building and distributing more income. That's the whole point of this thing, is what gives you the best probability of successfully building and distributing more money when you're going to need it the most. That's what people have to answer for themselves, and that's why this book was written. The primary purpose of life insurance, it has only really one purpose, is to replace lost future income. People lose income three ways. They die, they retire, or they become disabled. You've got them covered any which way. People have been taught that buying life insurance, it's a death benefit product. That's its only function. This is, unfortunately, how pretty much everyone, including most insurance agents, by the way, you guys are so fortunate to be with FEG because they understand the difference, and they care, where most people in this business, most IMOs, they're wholesalers. Hey, they don't care what you sell. They just want, can you kick her back up, Petro? They don't care what you sell as long as you get it through them. And they provide little or no training. You guys are getting the best of all possible worlds, believe me. I've been around in this business 45 years, and I've never seen a distributor like FEG so concerned with properly educating the people that are working with them. It's unbelievable the opportunity you guys have to learn and grow. Trust me, it's not available anywhere else, unless you want to go to Northwestern Mutual and drink the Kool-Aid and be indoctrinated as a be-your-own-banker kind of guy. The death benefit, it's the heart of life insurance advertising. This characteristic of a death benefit for someone else, it's become conventional wisdom, in spite of the fact that only 15% of the population will ever die before they reach age 65. There's a very high and 85% probability of living to age 65. I'm not saying age 65 is a retirement age. It's just the traditional, conventional wisdom age people have in their mind. People don't retire at some point in time. They retire when they can afford to. It's not a chronological event. It's a financial event. So in spite of this, most insurance, it's still sold for its death benefit value. Hey, Dave Ramsey, for someone else, the wife that gets the death benefit when the guy croaks at age 52, even though that probability of happening is very remote. So how do you buy life insurance to benefit the wife or somebody else? Well, the first thing is, why are you buying it? When you buy anything, you should have a purpose for buying it, or it will solve a problem. There needs to be a logical reason to get this stuff. So it involves setting goals, and if you never set goals, how do you know when you'll ever achieve them? Well, you won't, of course. So the next page is the common reasons people buy life insurance for its death benefit for someone else. And they buy it for income protection. This is the you die, we pay. It's for the wife and kids, widows and orphans. Maybe you want to upgrade your current coverage to get new living benefits and more coverage, more years of coverage, better conversion privileges than you're ever going to get with group, which doesn't have conversion privileges, by the way. Or most individual term policies, which are what I call stripped out. They're not quality. Read Chapter 4. And it's probably for the same or less money that people are already paying. Or tax-free survivor benefits. This is called Pension Max, and I believe it's at the end of Chapter 4. It's got a couple pages in the book that explains how you can buy a term insurance policy today, convert it right before you get your pension, and then leave your beneficiary the pension money or the insurance money instead of the pension money, and everybody's about $1,000 a month ahead. Loan payoff, okay, that's real simple. Mortgage protection, and there's a thing to remember on this, by the way. on this mortgage protection. A lot of people you're going to find, in fact, some of you folks may have gone through the mill with these guys, like NAA, National Agent Alliance. They're out selling this mortgage protection. Easy, and here's a simple concept for you folks to remember. Easy and cheap don't go together. The price of what you're buying is a totally separate issue from the cost of how you're financing it. So easy issue and cheap rates don't go together in the life insurance business. Term life, and I'm just going to read what I put together in a little sheet. I can send this to Petro if you guys want it later. Term life policies targeted to new homeowners are a good example of how this works. These are frequently called mortgage protection or mortgage cancellation, and the marketing emphasizes, it's really selling, no medical exam required. Nearly everyone qualifies. Only a few simple yes/no health questions. Have they made it easy to buy? Absolutely. Now, folks, do you think this easy financing has made their total cost go up or go down? I mean, get real. These are Table 4 to Table 6 products. Table 4 doubles the rate. Table 6 is 250% of a standard premium. These folks are getting hosed hugely, and they have no idea. Just to avoid a free physical paid for by the insurance company anyway, millions of these people out there are spending 2 to 3 times more than they otherwise would have to pay for their life insurance. You need to be aware of these and convert people out of this junk. This is garbage. Get people out of it. That's where you're going to find some extra money. And I'm sure you bumped into frequently people with some lousy term policy that they got through some outfit like NAA for mortgage protection that is an absolute road to nowhere. Get them out of it. You are to their financial health what their doctor is to their physical health. You're their financial doctor, and you need to take this seriously. Now, that's your loan protection. That's pay off the mortgage. Or estate taxes with pennies on the dollar. It just keeps the assets from being fire sealed. Step 2. Can you kick her down a little, Petro? Second step is to determine the right amount of coverage. In other words, the right base amount. If it's for income protection or upgrading or tax-free survivor benefits, you think of it as income and work backwards. You determine the right amount of income that the beneficiary is supposed to have, and then you subtract any other sources of income, and there's a net income amount that isn't covered, and that becomes a lump sum. And then if you're dealing with loans or estate taxes, that's a known amount in advance. You know, your loan is $200,000. Guess what? You need $200,000, and it's probably a good term insurance use. There's a great use here for term insurance. There's nothing wrong with term as long as it benefits your customer and not the insurance company. And unfortunately, most term benefits the companies, not the customer. Be aware of that. Let's go to the next page, Petro. We only have a couple minutes. Here's an easy way to calculate the money you need to replace $1,000. If you want $1,000 a month for 20 years, you need $150,000. If you want $1,000 a month for 15, you go down $25,000. If you want $1,000 a month for 10 years, now you're down to $100,000. It doesn't matter where the money is. You could have it buried in tin cans and gold coins in your backyard. If you want, for example, if you want $3,000 a month for 20 years, now you need 3 times 150. These are just rules of thumb. It assumes 5% and spending down to 0 at the end of 20, 15, or 10 years. It's called annuitizing. Even the extremely wealthy leverage the capital they need using life insurance. In fact, if I had to, in rewriting this, I may change even to the extremely wealthy first and foremost leverage the capital they need using life insurance. The extremely wealthy started the IUL bandwagon back 12, 14 years ago. They immediately saw the benefits of this product and started getting it in huge amounts. Now it's trickling down, and the philosophy is more becoming a little bit more mainstream. The third step is to determine the right amount of time that you want this coverage for. And your goal needs to be to get the right amount of coverage or death benefit for the right length of time. Now, if you can't do that for whatever reason, then get the right amount of coverage for the wrong period of time, which is better than getting the coverage wrong and the time wrong, if that makes sense to you. Go to the next page, Petro, and I hope we're done with this chapter here. The final step is look at your options for financing. You want to pay the least amount possible for the right period of time. When your purpose is to leave money to your beneficiary, the insurance is both a responsibility and an expense. I wouldn't call it a liability, I'd call it a responsibility. And yeah, it's an expense. But then so is your 401k and so is everything else. The insurance is an expense when you buy it to benefit someone else. Your reason why you're buying it won't change the fact that it's an expense. That's why, as a good consumer, you want to pay the least you can for it. And you want to quit now, Petro? Well, okay. So if the purpose is it's less expensive, you want to lock in the lowest initial rate for the appropriate time period. In other words, do you want the lowest total cost? Do you want the lowest starting cost? It's a difference between starting cost and total cost. And now you can also get living benefits for yourself. Because it's life insurance, a death benefit for someone else, treat it as a given. It's going to pay a death benefit. It has to, by law. It's a legal contract. You die, we pay. Now, what else will this product do for you, the insured, while you're alive? And you can still take care of your beneficiary. I've got a little saying we ran through it one time here, I remember. The insurance industry believes and trains its agents to believe that you're probably going to die tomorrow and that somebody else needs the money. On the other hand, I believe that you're probably going to die of old age and that you'd just like to live better in the meantime while still taking care of your beneficiary. Which strategy would you like your finances to follow? It's pretty simple. I think we're done with this chapter, Ron, and it's 2 o'clock. Hello?
Yeah, Dick, I've been muted out. Dick. So, you guys, we'll stop at the end of chapter 2. Dick, thank you so much.
Oh, you're welcome. My pleasure.
And you guys, I want to end by saying this. You know, I've been a proponent of this book for a long time, and I really want to just kind of challenge all of you. 2 areas. Number 1, please read the book. Please get good at this. This book taught me a ton, and the good part really kind of starts in chapter 3. This is the introduction. Read the book, underwrite it, put little stars where you want to, know what's in the book. It's not that big of a book. It's not that hard. And then, second is, please give it to your IUL clients. In 5 years, we want them to be able to refer to this book and understand what it is they bought. It's just the right thing to do. So this is a fantastic tool. Dick, thanks so much. Thanks, everybody, for being here. Tomorrow, next week, we're going to hit chapter 3. And I'm also going to have David Weiner on to talk about something he covered at the IUL University on indexing. It was fantastic. So thank you all for joining us. We appreciate your business. Go share the crusade, and we appreciate each and every one of you. Thanks for your time. Bye-bye.